When you tap Buy, the confirmation feels like a deed, a ticker, a fill, a line item that says you own a piece of a corporation. The balance updates, the tax form will someday list a dividend. In the language of ordinary life, that is ownership. On the shareholder register of almost every large American public company, your name is not there. The name that is there, again and again, is Cede Co, a New York nominee partnership of the Depository Trust Company. Cede is not a household brand. It does not advertise. It does not send you an app notification. It is the legal title holder of record for a custody book the industry describes at roughly $99 trillion in U.S. securities. That figure is not a vault of profit. Cede does not pocket the dividends. It does not keep the capital gains. Those still flow, by contract and by book entry, to the people who paid. What Cede holds is the official name on the corporation's actual books. You are what the law calls a beneficial owner. Your broker is a participant in a central depository. The depository's nominee is the registered owner. The industry phrase is street name. The street is a chain of records, not a sidewalk. The assumption that dies here is the assumption that buying a stock writes you on to the company. This arrangement is not a secret cabal. It is a settlement machine built in public, blessed by regulators, and treated as plumbing. Plumbing can still shock you when you finally look under the floor. Look once, and the app feels thinner. The contradiction the rest of this story has to answer is brutal in its simplicity. A nation that talks about shareholder democracy runs, for most shares, through a single nominee. The buy button is real. The cash is real. The legal title, for almost everyone, is somewhere else. Who put that name on the books? And why did the market decide that your name was too expensive to write? 1968. Wall Street is drowning in paper. The New York Stock Exchange is still a physical world. A trade is not finished when two men shout in a pit. A trade is finished when an engraved certificate, serial number, signature, transfer stamp, moves from a seller's box to a buyer's. Clerks compare names. Transfer agents cancel old sheets and issue new ones. Bicycle messengers, the runners of Lower Manhattan, ferry envelopes between houses that still think of themselves as partnerships with vaults. Volume is supposed to be a blessing. That year, it becomes a flood. Daily exchange volume climbs into the 12 million share range, and then higher, figures that sound modest now and were operationally catastrophic then. Back offices, the unglamorous rooms where the paper had to match the tape, fall days and then weeks behind. Certificates vanish into the wrong envelope. Fails to deliver stack up on the blotter. Firms hire anyone who can sort. Errors compound into capital trapped in trades that will not close. Member firms, some of them famous names, discover that operational loss can kill as surely as a bad position. The exchange tries the unthinkable. In 1968, it shuts on Wednesdays so clerks can catch up. It shortens the trading day. The humiliation is public. The market that sells America to the world cannot process its own receipts. Banks and brokers look at the jam and see a design flaw, not a temporary shortage of typists. If every sale requires a new certificate, the system scales with ink, signatures, and feet. Immobilize the paper. Keep the certificates in one place. Transfer ownership by changing numbers on a ledger. Stop moving the engraving. The idea has older cousins. Clearinghouses already netted obligations. Brokers already used nominee names for convenience. Custodian banks already held for clients. The late 1960s forced those cousins into an industry project with a single center. The Banking and Securities Industry Committee and allied efforts pushed toward a central depository. In 1973, the Depository Trust Company opens. Certificates, millions of them, are to be immobilized rather than shipped. The operational promise is brutal and elegant. If the paper sits still, the market can move. What most people miss is the legal bargain inside the operational fix. Speed required a concentrated registered holder at the top of each issuer's list so that a vast fungible position could be transferred among participants without a trip to the transfer agent for every retail sale. Companies still had agents, investors still had brokers. Between them rose a utility that would, as electronic trading arrived, sit under almost the entire public float. By the 1990s, physical certificates are already becoming relics for institutions. In 1999, the Depository Trust and Clearing Corporation is formed as the holding company that wraps the depository together with the National Securities Clearing Corporation, the engine that nets trades before they settle. Settlement cycles compress. T+5 becomes T+3, then T+2, and later the industry squeezes again. Each compression makes the old certificate world look more impossible, and each compression makes the concentrated nominee more indispensable. The Wednesday closures were a public failure of logistics. The solution was a property system that never needed a famous brand. A crisis of envelopes becomes, over 50 years, the way American corporate title actually works.
The blind spot is not that a depository exists. Serious money has always sat at a custodian. The blind spot is the last mile of language. Account statements say purchased. Annual reports still speak to shareholders. In between, corporate actions travel down a pipe built to stop paper from moving, not to put a household signature on a ledger. That pipe still runs. Follow the utility, not the ticker. The Depository Trust Company is a limited-purpose trust company, a New York institution supervised as a clearing agency and as a bank-like utility, sitting under the DTCC holding company, whose participants are the brokers, dealers, and custodian banks that need it to live. It is not a hedge fund. It is not a household asset manager. Its job is to be boring at enormous scale. Receive, immobilize, and account for securities so that members can settle among themselves by book entry. Cede Co is the instrument that makes the books of corporate America match that job. It is a New York nominee partnership. The name is a compression of certificate depository, not a dynasty. Issuers and transfer agents can print one registered holder for a mountain of fungible shares. DTC then keeps the subledger of which participant is entitled to how many. Participants keep the next ledger, the one that faces the customer. The partnership exists so a trust company does not have to appear, line by line, as the owner of record of half the listed economy, and so the transfer agent's register does not explode into millions of retail names every time a market order prints. Incentives line up with a cold clarity. Brokers want fast settlement and the ability to use customer positions, within rules, for margin, lending, and fails coverage. Custodian banks want a single place to park institutional bulk. Issuers want one address for dividends and proxies instead of a daily blizzard of certificate cancellations. Regulators, after the back office collapse, want a system that does not close midweek. William B. Denser Jr., the depository's first chairman, is not a celebrity founder. He is a former public official asked to make a market utility work, which is the kind of ambition this story actually contains. Make the trains run, then never be the headline. Member firms own the logic of the place. They pay fees, they sit on the need for netting. They fear operational risk more than they fear a philosophical argument about whose name is on a register. Transfer agents remain, computer share and the rest, as the official memory of each corporation. But for street name shares, their memory is Cede's bulk position. Broadridge and similar processors later industrialized the downstream mail, the proxies, the tax lots. Nobody in this chain is paid to restore the romantic certificate. Everybody is paid to keep the ledger moving. The psychology is not villainy, it is relief. After messengers and missing stock, a single nominee feels like hygiene. Hygiene hardens into structure. Structure hardens into the only way a modern trade can settle before the coffee cools. If you are looking for a person who decided that retail investors should vanish from corporate books, you will not find a smoking room oath. You will find a committee, a charter, a vault, and a partnership name that was never meant to be famous, only repeatable. Watch a modern market order as if it were a physical object, because the law still treats it as property, even when nothing engraved moves. A customer hits buy at a retail broker. The broker routes the order. On the other side, a seller's broker is doing the mirror image. Those two houses do not generally ship a certificate. They submit to continuous net settlement at the National Securities Clearing Corporation. Thousands of buys and sells collapse into a far smaller set of obligations. What remains to be delivered is not a sheet of paper. It is a book entry instruction at the Depository Trust Company. Debit one participant account, credit another. On the issuer's register, Cede Co still holds the same enormous block. Inside the depository, the block has been sliced between members. Inside the winning broker, a customer cash account is credited with a beneficial interest. 3 ledgers, 1 trade, no bicycle. Dividends follow the same gravity. The corporation pays its paying agent. The agent pays the registered holder, which for street name shares is the nominee. The depository allocates cash to participants according to positions as of the record date. Brokers credit customers.
The money arrives, the tax form prints, the customer feels paid as an owner, which economically is the point. Voting is slower, and this is where the chain shows its joints. The issuer prepares a proxy, materials go to the registered holder. The depository does not hold a town meeting in a vault. It passes voting rights down to participants. Brokers, often through industrial processors, solicit the beneficial owners. Some customers are non-objecting beneficial owners, and their names can be passed along. Others object, and they remain a position without a face. Turnout in retail votes is thin. Brokers may have residual or discretionary voting in limited cases, under exchange rules that have tightened over time. The shareholder meeting still happens. The quorum is often a nominee mountain plus a scatter of registered holders. Securities lending cuts across the romance. In a margin account, the customer agreement typically lets the broker lend shares. The borrower may sell short. Dividends become manufactured payments. Voting rights can sit with whoever holds the share on record date.
The cash account customer is in a stronger position, but even there, the registered name is still not the household name. None of this requires a conspiracy. It requires contracts most people click through. Then a broker fails. The wound the system never fully closes is the difference between a property right against an issuer and a claim against an intermediary. SIPC exists to move customer securities to another firm within limits when a member collapses. The 1960s taught the industry that operational chaos could freeze capital. Later failures taught customers that street name is only as sturdy as the participant and the recovery process. Entitlement, in the Uniform Commercial Code's Article 8 language, is a specific legal object, a package of rights against the securities intermediary, not a miniature deed sitting in a drawer. Idealism says a share is a direct stake in a corporation. Reality says a share, for most people, is a credit in a participant's account in a depository whose nominee is on the books. Ambition wants T+1 and instant everything. Constraint is the old fear of lost certificates colliding with a new fear of concentrated plumbing.
And then retail tries to leave. Direct registration, DRS, is not a meme invention. It is a facility that lets an investor appear on the issuer's register through the transfer agent, typically in book entry, even then, without a paper certificate in a home safe. The name on the company's list becomes the person's name or a trust's name instead of Cede's bulk. Brokers can transfer shares from the depository position to the agent. It takes time. It can take fees. Liquidity back into the street can require transferring the other way. After 2021, GameStop shareholders turned DRS into a campaign. Computer shares tallies become a public scoreboard. Forums treat registration as an act of recovery. Companies with passionate retail bases watch their registered counts rise. Transfer agents process volumes they did not advertise for. Brokers warn about delays. The depository's bulk position for those names shrinks by a visible slice. The campaign does not overthrow the utility. Most of the American float never moves. Index funds, pensions, and ordinary app users remain in street name because trading is easy there, and because the default is the default.
Still, the movement does something the paperwork reformers never advertised. It makes legal title feel like a choice again. In present tense, a transfer agent account shows a direct holder. A proxy arrives without a broker's forwarding stamp. A sale back through a broker requires the shares to re-enter the depository's world. Convenience and title pull in opposite directions, and the rope does not snap cleanly. Leave the wound open. The same architecture that stopped Wednesday closures also means that shareholder democracy, stock lending, short settlement, and bankruptcy recovery all run through a handful of ledgers.
A private nominee partnership remains the technical registered owner of a corporate economy its partners do not claim as profit. People who want the name back pay in friction. People who want the buy button keep the chain. The market calls this efficiency. Efficiency is not the same thing as the story you were told when you first pressed buy.
Ownership in a book entry country is a stack of rights that can be perfectly real and still refuse to look like a deed. The quiet mystery here is not a masked hand stealing dividends. Cash still falls downhill to the person who paid, which is why the 99 trillion figure is a measure of registered title, not a pirate treasury. The mystery is how a civilization taught its citizens that a share was a name, then built a market that could only run if most names were replaced by one partnership line. Familiar life still talks as if the factory, the patent, the vote, and the residual claim belong to the household that saved. The register belongs, for most of the float, to a nominee that was invented so messengers could stop writing. That gap is not a glitch. It is the price of speed, netting, and a trading day that no longer needs a Wednesday funeral. Direct registration proves the older idea is not dead. A person can still surface on an issuer's books. The fact that doing so feels like a protest tells you how completely the default swallowed the folklore. Institutions accepted the swallow decades ago because they were always in custody. Households accepted it because the interface was kind. Kindness is an incentive. So is the ability to lend, to margin, to settle before doubt arrives. Stand over the board, and the pattern is almost architectural. Paper failed in public. A utility succeeded in private. Law recoded the customer as an entitlement holder. Apps translated the entitlement back into the verb own. Each translation was rational. Together, they produced a corporate electorate whose official role is a nominee, and a public that only notices when a campaign, a failure, or a proxy fight makes the role visible. The aftertaste is not doom. Markets clear, pensions get paid, companies raise capital without waiting for engraving. The aftertaste is thinner than a certificate and heavier than an icon. Somewhere a register still has a line for Cede Co, and somewhere a person still believes the line is theirs. If the buy button and the shareholder list tell two different stories, which one is the country actually using when it says the word ours?